In this video guys, I would like to go over on two companies that I consider as the best buy at its every dip, though they had recovered a little bit as the broader market had recovered lately, in which Nasdaq had recovered from its low of 12,281 it had posted last March 8, 2021, to which this sell-off had lasted for almost a month, which we saw the decline of S&P 500 to as low as 3,723 in March 4, losing 5% from its high of 3,925 it held last February 11, 2021. In a situation like this, you need to know the stock you are holding, so you will not be selling your position in every market sell-off, which the shorts had exploited in reference to the increase in interest rates and fear to inflation. That said, my portfolio during that time lost over 30%, headed by NIO as my biggest holding if you had followed my previous blog, and to my portfolio which I had published last January. Good thing it had recovered so far, closing $46.03 on March 11. But this favorite stock of mine is still trading below 31% from its all-time high of $66.99 and 25% below from its fair value, which is the average street target or the Wall Street target of $60.99. NIO might have disappointed the Wall Streets when it missed their earnings per share expectation of negative 0.07, as it had posted an EPS of negative 0.16 for the period ended December 31, 2020. The stock had tanked since then, with a couple of price downgrades by Jefferies Financial Group from $60 to $38.80. And JP Morgan had reduced as well from $75 to $70, as NIO had lowered its growth forecast for Q1 of 2021, in which it looked forward to deliver 20,000 to 20,500 units, just an increase of 15 to 18% from the Q4 of 2020. However, my investment thesis to NIO remains the same, as it had positioned itself to being a luxury brand, not just a car manufacturer, which focus is the top-end and luxury lifestyle among its owners through excellent service and top-notch technology like BAAS and NIO's autonomous driving, which by the way will also be available as a subscription as a service. Its 87 would probably define NIO's luxury offering, which can give Tesla's Model 3 and Mercedes-Benz a run of their money. Moreover, the battery subscription and their autonomous driving as a service would provide the company a consistent source of revenue at the long run. That is, when deliveries would be sluggish brought by supply chain constraints and competition, the company can still have a lifeblood from its subscription. Noting that NIO's cost of capital is not that high compared to their auto manufacturer by outsourcing its manufacturing to Japan. That said, guys, each companies don't need a factory for them to succeed, as we may know that the auto industry is very capital-intensive industry. With this, the business model of NIO outsourcing their car manufacturing gives them competitive advantage towards preserving their working capital for technological innovation, as the case to features of 87. And by the way, their leadership on battery as a service subscription, as Mizuho analyst BJ Rakesh said that NIO is a leader and innovator in the upscale electric vehicle segment in China, in which BAAS is a key differentiator. Accordingly, this analyst provided his initial coverage for NIO with buy rating and a price target of $60. So for me, it just offset the downgrade of Jefferies. Furthermore, NIO owns a significant ownership with GAC NIO to produce mass vehicles at cheaper price. They also have an ownership with XPT Technology, a battery manufacturing company, and also hold a minority ownership with a Chinese ride-sharing company, Dida Shuseng, which it owns 17% interest. For me, there will be a possibility increase on ownership of this company either through additional purchase of interest or they may have an eventual buyout or merger would mean higher valuation to NIO, which can support its $300 stock price, which is a target by Bailey Gifford. Therefore, buying NIO at this pullback or the next pullback is not a bad move. In contrary to this article by Motley Fool, avoiding NIO at this point of time is absolutely hilarious, as NIO's balance sheet is stronger than Tesla with current and quick ratio of 3.31 and 3.12 against to Tesla's 1.88 and 1.49 respectively. Actually, NIO is over on industry standard of 2:1 current ratio and 1:1 quick asset ratio. The higher, the better, guys. Meanwhile, debt-to-equity ratio of NIO is 30% and total ratio of 42% compared to Tesla's 56.3% of total debt-to-equity ratio and 55% of total ratio. Both company has excellent solvency ratio, which is less than 1. But come on, one good thing for NIO as well is their compound annual growth rate of 91.6%, which is 55% higher than Tesla come December 31, 2022 per TRKR terminal. Therefore, choosing a growth stock to bet this time with a high upside potential, it must be NIO. Would the market continue to crash again? One tech stock that I would love to consider to buy is Fsly. By the way, guys, if you have some stocks that you want me to cover or analyze, just comment that below. Fsly Inc. or ticker FSLY operates an edge cloud platform for processing, serving, and securing customers' application. Is a best buy to start for a position or for accumulation purposes once there's another sell-off. As edge cloud computing is a category of infrastructure as a service that enables developers to build, secure, and deliver digital experiences at the edge of the internet. We all know that now we live on the internet. We love to shop on the internet. We love to go to Amazon. We love to go to the web store or website of each company that may use Shopify. We love to watch Netflix. We love to do social media, right? It is a programmable platform, their technology designed for web and application delivery. Fsly, according to its investor presentation, sees the computing market to reach by $35.4 billion in 2022. Notable clients of Fsly were Google, Shopify, Pinterest, Etsy, Stripe, TED, among others. Therefore, Fsly, guys, position themselves to be a leader in a cloud computing, which to me, we must have one stock that has an edge or has a leader in cloud computing. It might be too late for this stock, but like I said, once the market would have another major sell-off, That is, Fsly would lose another 48% from its current price as of March 11 close of $75.44, in which the price will become $37.72 or falling hard to the gap of $23, then I would love to start a position with this high-growth technology company which has a compound annual growth rate of 34.3%, which revenue is projected to ramp up at $486.49 million per TIKR terminal in 2022. Fsly has a current ratio and quick asset ratio of 2.78 and $2.60, which shows that the company is very liquid. That is, the company can pay off its current liabilities when it came due while strengthening its balance sheet by having a debt-to-equity ratio of 0.09. And total liabilities over total assets or total ratio of 1.13, which means that investors has an assurance that the company won't have any problem with regards to its ongoing concern status or risk of bankruptcy. Fsly has a 52-week high of $136.50 it had posted on October 13, 2020. But it back to earth on October 30 when it closed at $63.51. Then fly again up to 119 on February 9 until the epic market sell-off when it dips to $62, which could be the best entry point, though it had now a current price of $75.44 as of March 11 close. That is, Fsly current price is 45% below from its 52-week high. Therefore, if the trend would remain the same or Fsly stock would run the same performance within the 3 months window, you might see a double of your money investing in Fsly at the short term, that is at least 3 months. That's all for today, guys. So if you like this video and you find it helpful, then click that like button. Also share this video and drop your comment below for any request for stocks that you want me to analyze or to cover. Also, if you're new to this channel, then click that subscribe button and your notification bell so you'll be keep updated on my upcoming videos.